we would like to invite President of the Federal Reserve Bank of New York, Mr. William Dudley, to deliver the keynote address.
Thank you so much, Governor, for sponsoring this conference with the Federal Reserve Bank of New York. It's our great pleasure to participate with you, and thank you for hosting it here in beautiful Bali. Today I plan to provide a brief summary of the U.S. economic outlook, incorporating recent U.S. economic data and global and financial market developments. I'll then discuss the implications of the outlook for U.S. monetary policy and explain how international and financial market developments influence my thinking. I'm going to be emphasizing two key points. First, financial market conditions do matter in determining the appropriate stance of monetary policy. Financial conditions affect households and firms' decisions, so that the transmission of U.S. monetary policy to the real economy depends to a large extent on how changes in monetary policy help to deliver the appropriate financial market conditions to support our objectives of price stability and maximum employment. But financial conditions also evolve in response to domestic and international developments. Thus, when I reiterate that U.S. monetary policy is data dependent, that includes not just the information gleaned from important economic releases such as payroll employment and retail sales, but also how financial market conditions react to economic and financial market developments in the global economy. Second, external events such as Brexit can have effects that go far beyond just their impact on global trade. Conversely, what we do in the United States has an impact far beyond our borders. And we need to take that into consideration in how we conduct and communicate monetary policy in the United States. So to put it simply, monetary policy is a two-way street, and we all need to be cognizant of that. As always, what I have to say today reflects my own views, and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. So turning now to the U.S. economic outlook. Despite the many twists and turns in the road so far, my baseline outlook for growth and inflation hasn't changed much in recent months. After a weak first quarter, real GDP continued to grow sluggishly in the second quarter. On the positive side, consumer spending rose much more quickly in the second quarter. But on the negative side, business fixed investment spending continued to disappoint. Residential investment was weak, and inventory investment was a substantial drag on growth. Looking forward, I expect economic activity to expand at roughly a 2% annual pace over the next 18 months, which would be appreciably above the pace that we've seen over the past 3 quarters. Over the remainder of the year, the economy should continue to get some lift from consumption and from a fiscal policy stance that remains mildly stimulative. Moreover, I anticipate that residential investment, which was weak in the second quarter, will rebound in the second half of the year. A 2% pace of growth would likely to be sufficient to continue to absorb the remaining slack in the U.S. labor market and to support inflation moving back towards our 2% objective. However, any forecast is uncertain and growth could turn out to be either higher or lower. So let me turn now to an assessment of the balance of risk around this growth forecast. I believe that a sizable pickup in the rate of growth of economic activity relative to that 2% forecast seems unlikely for a number of reasons. Although consumer spending strengthened substantially in the second quarter, that stronger pace is unlikely to be sustained going forward. That's because the fundamentals supporting consumption have softened somewhat. Real income growth moderated in the second quarter as the pace of job gains slowed and inflation rose, boosted by somewhat higher energy prices. Even with the surprisingly large addition of 287,000 jobs in June, the pace of improvement in the U.S. labor market does appear to have slowed somewhat. For example, over the past 3 months, payroll gains have averaged about 150,000 a month, as compared to an average of more than 200,000 a month over the course of 2015 and the first quarter of this year. But even 150,000 job gains per month would be consistent with gradually using up any remaining slack present in the U.S. labor market. Although I expect business fixed investment to begin to grow again in the second half, it will likely remain relatively soft, as profits have stagnated and election year uncertainty could act as an additional depressant. All else equal, investment tends to be weaker when uncertainty rises, because this creates an incentive for businesses to delay decisions until this uncertainty is resolved. Also, trade seems likely to exert a net drag on growth. There are two factors at play here: the relatively sluggish growth rate of aggregate demand abroad, and the continuing impact of earlier dollar strength on U.S. export competitiveness. Now, with respect to the downside risk to the growth outlook, one that's particularly hard to gauge at this point is the potential fallout from the result of the recent UK referendum. It's widely anticipated that UK growth will slow as a consequence. Although the direct impact of slower UK growth on US trade will almost certainly be very small. After all, total US exports to the UK are only about 0.7% of US GDP. There are a number of other channels that could amplify the impact of the Brexit decision on US economic activity. These include the potential adverse effects on European economic activity, on the perceived health of the global banking system, and on broader financial market conditions. Now, to date, the global financial market fallout from the Brexit vote has been short-lived, and US financial market conditions remain supportive to economic growth. Nevertheless, I believe that the potential aftershocks from Brexit pose medium-term downside risks to the global economy, and these risks need to be monitored. Now, turning now to inflation, I think the outlook hasn't changed much recently. Headline inflation, as anticipated, has climbed a bit this year, as earlier energy price declines have fallen out of the year-over-year inflation calculations. In contrast, core inflation has been broadly stable, with the core PCE deflator, that's the inflation indicator that we focus on, rising at a 1.6% annual rate over the past 4 quarters. That's moderately below our 2% objective. Now, the fact that core inflation has been broadly stable over recent months in the face of the earlier declines in energy and non-energy import prices, I think that's notable. It makes me somewhat more confident that overall inflation will return to our 2% objective over the medium term, as long as the economic growth that I expect actually materializes. If the economy were to grow at the pace I discussed earlier, this would likely translate into sufficient job gains to continue to remove any remaining slack in the labor market, which by my assessment is already operating quite close to the level consistent with what is achievable on a sustainable basis. If we got this outcome, this would likely lead to further pressure on labor resources, higher wages, and over time, somewhat higher inflation. In contrast, if growth were to fall below my forecast, then I would be less confident about inflation moving back to our 2% objective. In addition, I put some weight on the fact that surveys from both the University of Michigan and the New York Fed indicate that households' longer-term inflation expectations have declined somewhat over the past year and are towards the lower end of their historical ranges. Nevertheless, I'm not unduly worried about this because the magnitude of these declines has been quite modest. And because the New York Fed's 3-year inflation measure has actually been increasing since January and has reversed much of the decline that we observed in the second half of last year. Now, if longer-term inflation expectations were allowed to become entrenched, this would be quite serious because it would act as a restraint on actual inflation and would make it more difficult for us to achieve our inflation objective. Now, in contrast to the inflation expectations from the consumer survey measures, I put less weight on the significantly larger declines that we've seen in market-based measures of inflation compensation. From my perspective, these declines seem driven more by changes in bond risk premia and the relative liquidity characteristics of nominal versus inflation-protected Treasury securities, rather than an indication of sharply falling inflation expectations. Now, if, as I indicated, US growth and inflation outlooks have not changed notably, then why have expectations about US monetary policy shifted so much over the last 6 months? Compared to the start of the year, the expected timing of any further Fed interest rate hikes has been pushed back, and the expected upward trajectory of US short-term rates is now much flatter than it was at the beginning of the year. I think there are several reasons to explain these shifts. First, assessments of the neutral real short-term interest rate have declined as economic growth has consistently fallen short of consensus forecasts. With the US economy having grown at only a 2.1% annual rate over the past 7 years, it's become harder to sustain the view that the neutral real short-term interest rate is close to, or will be close to, its historical level of around 2%. Estimates of the neutral real short-term rate that can be obtained from many of the DSGE models used within the Federal Reserve System are mostly clustered around 0, and that seems like a reasonable estimate to me. An implication of that, then, is that at present there's only a small gap between the actual real short-term interest rate, which is around -1%, and the neutral real short-term rate, which I currently peg at around 0. In other words, if you put these two things together, US monetary policy is accommodative, but only moderately so. In addition, I think many have come to question the view that the headwinds from the financial crisis are temporarily depressing the neutral short-term rate, and that the neutral short-term rate will soon rise significantly in the future as these headwinds dissipate. If the headwinds have not dissipated to a meaningful degree in the 7 years since the recession ended, then why should one expect them to necessarily diminish quickly over the next few years? Evidence is accumulating that some of the headwinds are likely to prove more persistent. For example, consider the reduced availability of mortgage financing for those with lower credit scores. That seems likely to continue. Lenders now appreciate that US home prices can decline significantly. Thus, they cannot rely as much on the value of housing collateral in securing their mortgage loans, and consequently now put much more weight on the credit histories of the borrowers. Market participants may also be taking some signal from the gradual decline in the median long-term federal funds rate projections of FOMC participants, which is shown quarterly in the FOMC's summary of economic projections. I think this gradual decline indicates a growing consensus that the neutral real short-term rate will not return anytime soon to its historical norm of 2%. A second reason for the downward adjustment in US interest rate expectations is that US financial market conditions depend in part on the stance of US monetary policy relative to the stance of monetary policies abroad. If the economic outlook abroad deteriorates, and this causes foreign countries to pursue a more accommodative set of monetary policies, then the dollar would likely appreciate, other things equal, reflecting expectations of relatively lower interest rates abroad compared to US interest rates. In this case, the US may need to adjust its own monetary policy path. If the FOMC did not make this adjustment, the stronger dollar could result in an undesired tightening of US financial conditions. The expected forward interest rates paths in Europe and Japan have fallen considerably this year. If the FOMC had followed the median federal funds rate path from the December 2015 SEP projections, which had a median of 4 interest rate hikes in 2016, then the US dollar would likely have appreciated much more significantly. Instead, the US interest rate path has come down in tandem with the foreign interest rate paths, and the dollar has appreciated only modestly. Now, this is a crucial point, and I want to make sure there's no misunderstanding. The Federal Reserve is not targeting the exchange value of the US dollar. What the FOMC considers are financial conditions broadly defined, because they affect the savings and investment decisions of households and firms. The dollar is but one component of financial conditions. The level of short and long-term interest rates, credit spreads, and equity prices are also important components of financial conditions that we monitor closely. If international developments shift U.S. financial market conditions, including the dollar, then we need to take that into consideration in our U.S. monetary policy decisions. Third, I found that market participants broadly appreciate that the FOMC needs to take a risk management approach in its conduct of monetary policy. There are at least two aspects of this approach. The first is whether the balance of risk to the outlook for either economic growth or inflation are skewed to either the upside or the downside. The second is whether the efficacy of monetary policy itself is asymmetric when monetary policy is at or close to the zero lower bound for interest rates. In this situation, it may be easier to implement a tighter monetary policy through raising rates than it would be to implement a looser policy using unconventional monetary policy tools. Also, the effect of a policy of raising interest rates may be more predictable compared to the effects from using unconventional tools. As I noted earlier, I think the medium-term risks of the U.S. economic growth outlook are somewhat skewed to the downside. Thus, this needs to be taken into consideration in terms of the appropriate stance of U.S. monetary policy. With respect to the efficacy of monetary policy, given how close we are now to the zero lower bound for interest rates, I also think the risks here are asymmetric as well. Therefore, we need to be a bit more careful about the risks of tightening monetary policy in a manner that proves to be premature as compared to the alternative risk of being a little late. If we were to realize that we were slightly late, policy can be adjusted by raising short-term interest rates more quickly. All three of these reasons evidence that U.S. monetary policy is currently only moderately accommodative. The fact that U.S. financial conditions have been influenced by economic and financial market developments abroad, and risk management considerations argue, at the moment, for caution in raising U.S. short-term interest rates. So directionally, the movement in investor expectations towards a flatter path for U.S. short-term rates seems broadly appropriate. That said, to my eye, market expectations drive from federal fund futures prices, which price in no more than one 25 basis point rate hike through the end of 2017. Those expectations appear to be too complacent. If the incoming information validates my view of the outlook, then I believe U.S. monetary policy will need to move at a faster pace than implied by future prices towards a more neutral posture as the labor market tightens further and U.S. inflation rises. Moreover, I think market expectations may be putting insufficient weight on the possibility that the economy could actually outperform our expectations, that financial conditions could ease, or that the risk to growth from Brexit and other international developments could fade away. If such events were to occur, this might necessitate an even faster pace of adjustment. For these reasons, I think it's premature to rule out further monetary policy tightening this year. As I said before, it depends on the data, broadly defined, and as we all know, that is not something that one can predict with any great accuracy. Now, the U.S. economy plays a large role in the global economy. Most significantly, the U.S. economy represents a sizable share of world GDP, roughly 25% at current exchange rates, and the U.S. dollar is the most important international reserve currency. More than 60% of central bank reserve assets are denominated in dollars, and that share has been stable to rising in recent years. Most foreign trade is denominated in dollars, and most foreign currency debt issued by corporations abroad is denominated in dollars. Thus, what happens in the U.S. economy, U.S. financial prices, and the exchange value of the dollar has important implications for the global economy. At the same time, though, prosperity is very much a two-way street. Developments outside the United States affect our domestic economic outlook through their impact on trade and financial market conditions, and we have to take such developments into consideration in our monetary policy decision-making. In many ways, international linkages have become more important over time. This is because international trade has increased rapidly over the past few decades as the world economy has become more developed and globalized. This is true notwithstanding the flattening we've seen in the global trade to GDP ratio over the past few years. And global trade interactions have become more complex as supply chains have become more extensive and intricate, often involving many different countries. Financial markets across the globe have also become more integrated. Developments in one market now appear to have larger effects on other markets than was generally the case historically. So consider, for example, how European and Japanese central bank quantitative easing activity has helped drive down long-term US Treasury yields this year. Or in the other direction, consider the global bond market taper tantrum that occurred in 2013 when markets reacted to then Chairman Bernanke's musings that the Federal Reserve was beginning to evaluate when the time would be right to begin the tapering of the Fed's asset purchase program. Or in a similar vein, consider the international financial market reaction to China's decision last year to alter its foreign exchange rate regime and how the RMB is managed relative to the dollar versus a broader basket of foreign currencies. The growing interdependence can also be seen in the increased correlation of market movements both across countries and across asset classes. Periods of risk-on versus risk-off trading now occur on a global basis. For example, equity market movements in developed and emerging markets have exhibited a 76% positive correlation over the past 6 months. This is only slightly below the all-time peak, which I hope we never see again, of 82% in 2009, and significantly below the 57% correlation that prevailed between 1995 and 2007. Correlations across asset classes have also been increasing. So consider this set of assets: 10-year treasuries, US equities, international equities, oil, the VIX, the trade-weighted dollar index, and the BBB credit spread. We can construct a variable called a common factor to capture all the co-movements of this series in this set. The more closely the series movements are tied together by one factor, that means that the things are moving together. Currently, the derived common factor accounts for 50% of the variation in these financial variables. That's up from 30% in early 2014. Oil in particular has become much more correlated with other assets. Prior to 2008, oil was virtually uncorrelated with equities and treasuries, whereas in 2016, its correlation with these two asset classes has been more than 45%. These effects are transmitted by many linkages, not just through trade and financial markets. Consider the many different channels of potential Brexit influence. Not only the impact on international trade and global interest rates and currencies, but also on bank equity prices and on political uncertainty. Given this interdependency, what should we do about it? Interdependency and linkages do not mean that US monetary policy should subordinate its domestic goals for international ones. That's because the Federal Reserve has a clear domestic-oriented mandate that was set for us by the US Congress. Instead, I believe that setting US monetary policy to best achieve our domestic mandate will also help support sustainable growth and development abroad. As I see it, there are two key steps that are essential in the design of an appropriate monetary policy strategy. Step one is to take an expansive view of the global ecosystem in which we all operate. We need to take into consideration that our decisions have broad consequences for the global economy, and conversely, that international developments can have significant consequences for the US economic outlook, and therefore the appropriate stance of US monetary policy. As part of this, we need to be nimble in incorporating new developments into our monetary policy decision-making. Step two is to communicate clearly and consistently. That means clarity about the objectives of monetary policy and how the Fed plans to meet those objectives in light of the economic and financial market environment, and how it formulates its responses to unforeseen circumstances that might lead to revisions in its economic forecast. In my view, the Federal Reserve is making progress in both of these areas. With respect to the first step, I believe we do take an expansive view of those factors that affect the U.S. economic outlook, and we do revise our views accordingly. Our speeches, statements, and actions this year, I think, illustrate that that's how we operate. For example, after the market turbulence that we saw at the start of the year, we kept monetary policy on hold at the March FOMC meeting. And we explicitly referenced in our statements, quote, readings on financial and international developments. Similarly, in speeches prior to the Brexit vote and in the FOMC minutes, we raised our concerns about the risks of disorderly outcomes associated with the UK referendum. For example, the June FOMC minutes state, quote, most participants noted that the upcoming British referendum on membership in the European Union could generate financial market turbulence that could adversely affect domestic economic performance. In addition, I think we're doing a reasonably good job incorporating the flow of new information into our forecasts. The fact that the federal funds rate projections from the summary of economic projections have changed significantly from quarter to quarter indicates that FOMC participants are responsive to new information. Now, some have expressed an alternative view that the movement in these rate projections is an indication that the FOMC's reaction function is unstable and unmoored. I don't see it that way at all. The forecasts of FOMC participants with respect to growth and inflation have not changed much this year. But what has changed are expectations about what monetary policy stance is needed in order to achieve those outcomes. It's important to emphasize that the interest rate projections in the summary of economic projections are not commitments. They are point-in-time views of the appropriate interest rate path and are updated as economic circumstances and financial market conditions change and evolve. With respect to communication, in recent years, the Federal Reserve has shifted towards much greater transparency. This includes quarterly press conferences by the Fed chair following FOMC meetings, publishing growth, inflation, and short-term interest rate forecasts of FOMC participants on a quarterly basis, and a concerted effort to lay out the guideposts that the FOMC will look at in assessing progress towards our dual mandate objectives. On the communication front, though, although we've come a long way, I would admit that there is still room for further improvement. For example, the focus of the SEP on each participant's modal forecast doesn't convey much uncertainty about the economic outlook, how much certainty there is about the economic outlook. Similarly, language used in the FOMC statements can become stale over time. We tend to make relatively few changes to the statement language each meeting because of the acute market sensitivity to whatever changes we make. One could argue that this might not be the best practice to follow, but we should recognize that there would also be significant transition costs if we were to do more extensive revisions to the statement at each meeting. For monetary policy to be effective, it's important to have clarity about what the FOMC can be clear and consistent about. Its manner of responses to mitigate the potential harmful effects of disturbances and the goals of policy. In contrast, our monetary policy projections and the actions we take cannot be static. If economic circumstances change, then monetary policy needs to change too. Otherwise, we won't be able to achieve our objectives. Thank you for your kind attention.